presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compac Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compac YouTube Market Wrap Update for April the 14th, 2025. I'm Mo Ansari, President of Compac Asset Management, and thank you for joining me today. First of all, don't forget to subscribe to this channel. Just click on the subscribe button, and every time I post an update, you'll be notified and you can watch it at your convenience. Let's start with the numbers last week. Big week to the upside, a lot of volatility in the market. And you look at where we are right now. We've come back up. We were up 5.73% for the S&P last week. Year to date, we're down 8.5%, just about 8.5% for the week. So it has been extremely volatile, up and down. As I mentioned, I think this volatility is going to continue, that we are going to continue to see this up and down movement. We're getting the bounce off the third wave. The fourth waves are usually back and forth, up and down, as I mentioned, for the last couple of weeks. And we've seen a lot of volatility. But if you have the right portfolio and you're basically have the volatility that you expect, then you're doing better than the market. Market is down 8, you're down 4 or 5%, or somewhere around there. You're comfortable with the market overall after 2 tremendous years in the market. I know the volatility is disconcerting a little bit, but again, as long as you keep the bigger picture in mind, that is the thing that you have to keep in mind. Looking at the Dow Jones, up nearly 5% for the week. The Russell lagging quite a bit, not up as much I would like to see, only up 1.83, while the NASDAQ had a big week to the upside, up 7.3%. This is the way I like it, where the NASDAQ is first, then the S&P, and then the Dow. As long as we have this configuration, that is usually a good sign for the market. Technology was the big winner last week, up 9.7%. Energy was the worst performer, only down slightly. But looking at consumer staples, these are the big companies, the soap companies, the companies that make detergent and things like those, the safe stocks as they're called, where people have to buy these things, recession or no recession. The chances of a recession continue to rise, even though we've seen a back off on the tariffs, but the tariffs have created a tremendous amount of uncertainty. Uncertainty causes people not to spend as much money. Individuals don't spend as much money, and businesses do not invest in new facilities because they don't know what the demand is going to be. They don't build as many factories. They don't buy as much equipment. And with that, we see a slowdown in the economy, and that is usually a harbinger for a recession. Are we going to get there or not? We'll have to wait and see, and it'll depend on how this tariff war unfolds over the next 2 or 3 months. So it'll be a choppy period for the next 2 or 3 months. Oil was up a little bit last week, but the big move was Treasuries. They went up, interest rates went up nearly 0.5% last week, from 4.01 to 4.48. And that is the surprise, that a lot of people were not expecting interest rates to go up. But interest rates went up nearly 0.5%. With the economy slowing, usually interest rates go down. But there is a concern that the budget deficit could go up if we get a lot of tax cuts. There's a concern that due to tariffs, we might see inflation going up, which means interest rates have to stay up. And I think another concern that people are worried about is the dollar coming down. Is there going to be demand for U.S. bonds? And that is what really rattled, I think, the administration when the bond market interest rates started to go up, and everybody got very worried that the bond market would start to rise. Now, the bond market is much larger. It is a linchpin of the global economic system right now, is the U.S. Treasuries. If the demand for U.S. Treasuries goes down, the demand for dollars goes down. The demand for how are we going to finance our deficit of $2 trillion that the government is spending? It has to borrow that money from somewhere, and the way it borrows that money by issuing bonds. But if the demand goes down, then the interest rates go up to make those bonds more attractive, and that is not good for the economy. So that is what really rattled everybody. But looking at the overall picture, if you have a 60-40 portfolio, that means 60% stocks and 40% bonds, you're going to see over a 1 month period relative positive returns to starting value and outperformance over cash. Nearly, you can see over a 1 month period, nearly 70% of the time. If you hold 60%, 60-40 portfolio, 80% of the time it outperforms cash. And a lot of people are running to cash for safety, but if you look at it over a period of time, over a 7-year period, it's nearly 90% of the time that your 60-40 portfolio is going to outperform cash. So going to cash and sell everything is not the answer, because you give up the upside returns that you could get, and at the same time, you don't get any extra safety being in cash. For very short periods of time, for a week or 3 days or 4 days, there might be a period where cash might outperform a balanced portfolio. But again, what kind of portfolio you have depends on what kind of risk you're willing to tolerate, what is your emotional makeup, how much volatility you can handle, and where you are financially. If you're financially in a comfortable position, you don't need to be swinging for the fences. You don't need the home runs. It's the singles and doubles that win the ball game for you. And if you are in a comfortable position, you've already won the ball game. The question is, you don't want to snatch defeat from the jaws of victory, trying to get too much return by taking too much risk or not having enough return in your portfolio, so you don't outperform even inflation. So prices go up, but your cash sits there, and you get less and less of whatever you want to buy because prices continue to go up. That is something that cash does, and that's the problem. Headlines, we saw CPI was down, inflation was down to 2.4%. Consumer sentiment, that is how people feel, it fell to one of the lowest levels, I think, in 20, 30 years or longer, where we saw people are just very nervous with the economy right now. And that usually translates into buying less stuff. This week, we don't have a lot we got retail sales coming out, expected 1.4% increase in retail sales. Last month, we only got 0.2, so we expect that. Without autos, 0.4, we'll have to wait and see. Capacity, so not a lot of economic data coming out. But on Wednesday, Jerome Powell is going to talk, and that's going to, I think, give us some more ideas of what the Fed is thinking at this point. Looking at the technicals, we bounced back up exactly to the 20-day moving average. That's what we were seeing. That is the bounce that I was expecting, and that is about as far I think we can go on this. We're at 54.24. High today was 54.60, and the 20-day moving average is 54.65. So we came and kissed the 20-day moving average. Again, this is wave 1 down, 2 up, 3 down, and then we get 4 up and 5 down again. So we're in the 4th wave now. We made the 3rd wave bottom right here. Looks like it on the daily charts. Now we're going to go back and forth, up and down for a period of time. Looking at the weekly charts again, seems like we've made a 4th wave bottom, come back up all the way. 5,700 is a 20-week moving average, 50-week moving average. So we'll see. Markets are going to, I believe, again, 4th waves are back and forth choppy periods, and that's where we are. Looking at the NASDAQ, back above the 20-day moving average, which is a good sign here. That is 1733. We were 17,033. We were a high of 17,136, but now we're coming back below it. We're at 18 as I'm doing this update at about noon on Monday. We are expecting. So resistance still at 18.2. And looking at the weekly charts, dot plot still negative, or the market, the vertical lines are the negative, is the market, and this is the dot plot right here. As long as the market, which is this, is below this dot plot, that is a negative sign for the market. 18,117 is the 20-week moving average, so we'll have to wait and see if we can get above that. Again, looks like we made a 4th wave, could get a rally to the 5th wave. But I think, again, we are going to, 4th waves are back and forth messy for a period of time. 10-year note, interest rates plummeted today, down 13 basis points, which is a big move to the downside. 4.33 is the 50-week moving average for the yield. On the 10-year, the interest we have to pay, it was as high as 4.6 on Friday. So that was the big scare. but now the rates are normalizing and coming back down. Again, 4.36, you need to get below 4.33, and just around 4.22 is the number. Small caps, very negative, below the 200-week moving average. No reason to look at those. The gold market looks like a fifth wave top, and we're down about $26 or so today. Support is going to be at around 3,100, 3083 is the 20-day, and then 29.66 or 88, 29.88 is the 50-day moving average. Gold, I think, has got a lot of movement due to uncertainty and people worried about it. If the interest rates start to come down, and that means the anxiousness in the market is coming down, and the market stabilizes, that could bring the gold market back down to the downside. I think somewhere around 2,900 could be an opportunity for people who don't have gold to take a look at it. Those are my thoughts. That's what I'm looking at. Again, if you need help with your portfolio, go to invest@compact.com, send us an email, or just give us a call. We'll be more than happy to help. We'll do a free analysis of your portfolio, tell you how you should be invested, how much risk you should have. We'll sit down, talk to you. All of that is free. All you have to do is send us an email at invest@compact.com. Right down here is or just call 800-388-9700. And don't forget to subscribe to this channel. Click on the subscribe button so you will get notifications. Those are my thoughts. Those are my observations. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.